Hi, welcome to my YouTube class 11 Accountancy. As a practice, we are continuing with the Accountancy chapter, class 11 Accountancy chapter. That is the bills of exchange we had completed. So today we are going to start about the financial statements. As you know, that accountancy, the main objective is to find out the profit or loss of the business and shows the financial position of the business at the end of the year. As per the practice of accountancy, we are beginning with the journal, that means recording of transaction in the books of original entry. From journal, we are posting to the ledger account, that is the secondary books of entry. From posting, that is the classification of accounting records. From posting, we have tried to find out the arithmetical accuracy of the ledger balances through preparing trial balance. The last accounting process is to find out the results and interpret them. So this is the last accounting process, that is to prepare the financial statements and to find out the results of the business, to show the performance of the business. The business is eager to know the results, whether earning profit or loss, whether their assets are better than the liabilities and as well as the capital balances, or it is balanced, or there is a certain problems, mismatch. To know this, we prepare the financial statements. So here we are discussing the financial statements of sole proprietorship firm. When you go for the higher studies, 12th class, then graduation, post-graduation, like professional courses, chartered accountancy, cost accountancy, company secretaries, financial chartered financial analyst, MBA, there you will know the financial statements of the partnership firms and companies, corporate sectors. So here we are confined in class 11 financial statements. Class 11 accountancy financial statements is confined to the sole proprietorship firm. As you know, the sole proprietorship is a business which is run, managed and controlled by one man. That is the one owner. So he is responsible for starting his business, running his business and earning of the profits and losses. He is the sole profit bearer, is the sole risk taker also. So that sole proprietor is also interested to know his financial results at the end of the year. So that is the financial statements of sole proprietorship we are going to discuss. Let's begin with the financial statements of the sole proprietorship firm. What is financial statements? As you know, the financial statements is the statement which is prepared at the end of the accounting year or the accounting period to know the financial results. That is called financial statements. Statements prepared to know the financial results of the business at the end of the accounting year or the accounting period is called financial statements. Why this is prepared at the end of the year? Because after all the transaction is completed, transactions process is completed, accounting process is completed, this is the end product to prepare and to show the results of the business at the end of the year. It is not prepared earlier or before, because at the early we cannot prepare this financial statements to find out the results, because we are beginning with the transactions and we cannot prepare in the middle of the year. Though we can prepare till the half year end. But half year results is coming, not the full completed years. Accounting years consist of 12 months period. That is the accounting periodicity concept. As for this concept, you have to take 1 year transactions, 12 months transaction to prepare the financial statements. So that's why it is prepared at the end of the accounting year or the accounting period. As you know that accounting period begins from the 1st April to 31st March, or calendar year begins from 1st January to 31st December. So 12 months period is to be taken into account before preparing the financial statements. So this is the financial statements which is prepared at the end of the year to find out the financial results of the business. What are the financial statements you will prepare at the end of the year? You can see this classification of the financial statements. Financial statements is classified into two types. That is the income statement. This is first one. Then the second one is your position statement. This is second one. That mostly these two statements is to be prepared. Other than that, there is some other statements will be prepared, part of the financial statements, which you will know it in your higher studies. Already I have told you we are confined to the financial statements of the sole proprietorship only. That is to trading profit loss account, income statement, and second one is your position statement, that is the balance sheet. So that is the classification of financial statement here. That is the income statement, first one. Second one is your position statement. Income statement, that is the this statement is otherwise called trading profit or and loss account. That is the common statement. That is the income statement is commonly known as the statement which is to be find out the income of the business, profits of the business. That is called income statement, and it is commonly known as trading profit and loss account. That is the income statement. That means trading account as well as the profit and loss account. These two accounts is to be combinedly prepared to find out the income of the business. That is the income statement. What is the main purpose behind this income statement? Why this income statement is prepared? Because as you know, the business main objective is to earn the profits. When we are doing the business, any business, our main sole aim is to earn the profit. So when we are earning the profit, so we should know whether we are earning profit or loss at the end of the year. That's why this statement, this income statement is prepared. So this is the main purpose of the business, and that statement I have determined the profit or loss of the business and fulfill the objectives of the business. So let's see the objectives of the income statement. The first objective is it determines the gross profit or gross loss. So this is gross profit or gross loss. That means either profit or loss. So that is the trading account is prepared, because income statement consists of two statements. One is your trading account, another is your profit and loss account, and it is combinedly prepared, jointly prepared, one account. So it is two parts. First part is your trading account, second part is your profit and loss account. The first part, trading account, which is prepared to find out the gross profit or gross loss of the business. Gross profit, gross loss means that is the in overall total income, total profits or the total loss. That is from buying and selling of goods and services. If the business is doing manufacturing of goods and services, then the manufacturing statement is prepared to find out the total cost of goods produced. Then it is transferred to trading account to find out the gross profit or gross loss. Gross profit or gross loss is the difference between the total sales of the business, including both cash sales and credit sales, minus total purchases during the year. That means credit purchases as well as the cash purchases. If it is a trading business, if it is a manufacturing business, total goods produced is subtracted from the total sales we will get the gross profit or gross loss. That is the first objective of the preparing trading account, profit and loss account. Then second objective is to find out the net profit or net loss of the business. That means net result. That is the main part of your preparing profit and loss account. So first part we have shown, that is the trading account to find out the gross profit or gross loss, profit loss account to find out the net profit or net loss of the business. That means what is the total net profit or net loss. So after subtracting all other expenses, losses from the gross profit added with the other incomes, any extra incomes, then we will find out the net profit or net loss. So this is the things we will calculate from, we will get it from the income statement, that is the trading profit loss account. That is the second objectives. Then third objective is, it helps in comparison with the previous year results. What is your current year profit, current year loss can be compared with the previous year profit or previous year losses. Whether we had improved or we had declined in our performance of the results or the performance in our assessment, we can easily compare. So this financial statement is prepared to help to compare your results of your current year with the previous year. Then fourth objective is to details. It gives details about the expenses and incomes. That means financial statement, through financial statement we will get the details of our total expenses and total incomes of the business during that accounting year or the accounting period. That means what is the total expenses, including your wages, salaries, rent, rates, depreciations, all those expenses. You will have the close eyes or the close watch over those expenses in your, through your trading profit loss account. That means this trading profit loss account, not only it helps to find out the results of the business, net profit, net loss, but also gives you a close watch, close eyes overview, overlook upon your total expenses and incomes. That means what is your the manufacturing expenses, what is your office administration expenses, what is your selling and distribution expenses, what is the other expenses you had incurred, so that your profit has been increases or decreases, and what are the other incomes you had earned. So this is a close watch, eyes, the close overview upon your total expenses and total incomes. Then the next objective is to calculate the different ratios, financial ratios. Your trading, we have prepared the trading profit loss account, not only fulfill our objective of finding out the calculating the net results of the business, but also it helps in calculating different ratios. So many ratios, financial ratios are to be prepared. So these ratios analysis your financial statements. The gross profit to net sales, net profit to net sales, that means gross profit turnover ratio, net profit turnover, net profit ratio, sales turnover, sales ratios, sales to total cost. That is the different ratios we will prepare. Expenses ratios, different expenses to the in comparison to the sales in percentage, so that we can have a close analysis, a detailed analysis over those ratios, through those ratios of the financial statements. So these are the objectives of preparing trading profit loss account or income statement. Then let's come to the second statement, financial statement, which is prepared to show the financial position of the business, that is position statement or balance sheet. So this is the statement which is prepared at the end of the year to know the position of the business. That's why it is called position statement. So the commonly it is called the balance sheet. The balance sheet, why it is called balance sheet? Because balance sheet is the statement which shows the balance between your total assets and liabilities in the capitals. So there should be a balance Already we had know it from your accounting equation that total assets should be equals with your total liabilities and capital. So this balance sheet proves at the end of the accounting year by preparing the financial statements, by taking into the assets, total liabilities and total capitals, whether there is a balance or imbalance. If it is imbalance, that means your business is not in a good position. Either there is a improvement of the results or there is a declining of your results performance. So always it should be balanced, it should not be unequal. So that is the balance sheet. So that is the statement which is prepared at the end of the year to know the financial position of the business. That is called balance sheet. So the main objectives of the balance sheet is, the first is to determine the financial position of the business. The business financial position is to be shown here. That means through your total assets, liabilities and capitals. What is your total assets, what is your total liabilities and what is your total capitals. That is the capital contributed by the proprietors. Already he wants to know whether his capital is increases or there is a decreases or liabilities increases. So since it is balanced with the total assets, what are the different assets it is possessed in the business? It shows the financial positions. Then secondly, it determines the solvency position. Solvency position means the obligations of the business, the short-term obligation as well as the long-term obligations of the sole proprietor. That is, he is the sole owner of the business. He wants to know what is his capacity to repay the short-term liabilities, means current liabilities out of current assets. That is the short-term solvency position of the business. That means liquidity position of the business. How much current assets he owns and how much current liabilities he has acquired. So whether that current assets is sufficient to pay up the current liabilities on demand or not. So that is the short-term solvency position that is to be known from your preparing this balance sheet or position statement. Then the second one is your long-term solvency position, that is calculated by comparing long-term assets, means fixed assets, by comparing with the fixed liabilities and capital. So this liabilities and capitals are compared with the total long-term assets or the fixed assets, so that the solvency, long-term solvency position is to be calculated. Solvency, this long-term solvency position also to be calculated through your debt equity ratio, which you will study it in your higher studies in the 12th class. About that, only just you know that long-term solvency position is the comparisons, the ratio to be prepared from your comparing of the long-term assets and the long-term liabilities. And lastly, it is the helps in comparing with the previous year results. So balance sheet also helps in comparing the current year results with the previous year results. It helps easy to compare. That means what is your current year position, what is the previous year position, last to previous year position. So last 3 years, 4 years, 5 years results can be compared with the current year, so that our performance is increasing or decreasing. So that is the objectives of preparing balance sheet or as well as the trading profit loss account or income statement. That means that is the main objectives of preparing the income statement and the position statement. Then next comes that why we should prepare the financial statements. Because since financial statement is the end product, end results of the business, to show the financial position, to show the net results of the business. So there are so many users are there. They are interested to use your financial statements. So there is the users of financial statements are here. That is classified into internal users and external users. Some users of financial statement are your internal users, means inside of your business. Who are they? There is the owners, managers and employees or trade union. First, that is the owner, that is the, so we are preparing already, I have told you beginning, we are preparing financial statement for the sole proprietors. So that is the one man business. So he is the owner of the business. He wants to know the financial statements, income statement as well as the position statement, to know about the net profits, net loss of the business as well as the his capital position, the assets and liabilities position from balance sheet. So there is the owner who is the internal users of the business. Second one is your managers. Sometimes sole proprietors appoint the managers to manage his business. He is giving the salaries. So he gives responsibility, assign the responsibilities to show the better performance of the business. So managers is interested to know the financial statements, whether his planning is success or not. That means whatever he has done the planning, according to that plans, he has achieved the financial results or not, profit or loss as well as the assets liabilities position. That is the managers. Then third one internal users is trade union as well as the employees. They are very much interested about, employees are very much interested about to know the financial statements about, mostly that is the income statement. From that they want to know about their wages. So whether there is a profit or loss. If there is a profit, they will demand for the higher wages, bonus, incentives and other benefits. So if there is a loss, certainly they cannot demand, because this is the transparency, this is the financial statement, how you can justify to your increasing of your wages. If your profit is there, then certainly they will demand for the higher wages, incentives as well as the bonus as well as other benefits for the employees. Trade union also demand all those things if the business earns the profits. So that is the financial statement, helps to know about by the employees. So these are the internal users. Some of the users of financial statements are external users, means outside the business. Who are the first one is your creditors or the suppliers, who supplies the goods on credit. So already we have seen discussed in the objective of position statement, there is the determined solvency position. There is a short-term solvency as well as the long-term solvency is discussed. Short-term solvency, that is the current assets, current liabilities proportionate. If current asset is more than current liabilities, your short-term solvency position is good, better. That means if your current liabilities is more than the current assets, that means your short-term solvency position is bad, worse. That means it is very dangerous. So you have to be very careful about that. So these things you will known by the creditors by that is shown from your financial statements. That means creditors wants to know your financial statement to judge the short-term solvency position, because creditor gives credit facilities while you are purchasing the goods on credit or if they are supplying the goods on credit. They need their money to be paid in time. If your solvency, short-term solvency position is not good, certainly they may not supply the goods on credit. So they will judge your short-term credit worthiness of your business. Then second one is your lenders or the bank. That means they are giving credit the long-term for the long-term purpose. Long-term solvency will be judged by the lenders or the bank before they granting the loan to your business. Business cannot run its with own money. So certainly the sole proprietorship will depend upon the external funds, liabilities, loans and debt. When they borrow the funds from the outside sources, certainly they will judge your financial statements, your long-term solvency position. They will compare your fixed assets with your long-term liabilities and your capital position, whether your capital is more or less, or your assets are valuable, profitable assets are there or not, so that they will judge it accordingly. They will grant you the loans, that is the lenders or the banks. Then third one is your government or the tax authorities. So they also know your financial statements, because government will give you certain subsidies, benefits for the business to establish the business. If the business is earning profit, then certainly they will charge them, withdraw the subsidies. Otherwise, they will continue with the subsidies. Likewise, if your business is earning losses, then certainly they will extend you the different helps. So that is the tax concessions and other benefits, so that your business will survive. That is, the government wants to know your financial statements. From that financial statement, they can know about your performance. Then tax authorities, they will charge the tax upon your net profit or the net losses. If net profit is there, then tax will be charged. If net losses will be there, then no tax will be imposed. So that's why the tax authority wants to know your financial statement. That means mostly the income statement, trading profit loss account and trading profit loss account, or the income statement. Then fourth one is your research scholars. They will make in-depth research analysis of your financial statement. They will give the various conclusions, various pros and cons of your financial statements, which you had shown the results. Accordingly, you can take the future steps to improve your performance, to improve your results. So this is the research scholars. For future studies, for the further development, the research is to be done. That's why they need your financial statement. And lastly, there is the public. Public also know your financial statements, because whether that business is earning profit or losses. When the business is started in the public by using the public resources, certainly the public eager to know about the business performance. If the business is doing good performance, profitable performance, then certainly the publics will be benefited through the social responsibilities. So this is the public which will want to know your financial statement. So they are the users of your financial statements. Then next is how you will prepare the financial statement. What is the basis? So as you know, financial statements we are preparing just after preparing your trial balance summarized statement. The trial balance is the basis which provide you the various ledger balances. On that ledger balance, you will prepare the financial statement. That is the income statement and the position statement. That is the trading profit loss account and balance sheet. But how will you prepare this? So before preparing the financial statement, you should be very clear about the business expenditures and business receipts. Business expenditure is classified into two types: capital expenditure, revenue expenditure. Likewise, business receipts or business income is classified into capital receipts and revenue receipts. If you are not clear, then you will be confused with the preparing your financial statements, because financial statement is exclusively depends upon this concept of the business expenditures and business receipts classification into two heads, that is capital expenditure, capital receipts, revenue expenditure, revenue receipts. Let's come first the expenditure classification: capital expenditure, revenue expenditures. What is capital expenditure? What is revenue expenditure? Capital expenditure is the expenditure which is done for the long-term purpose. That is for purchase of assets, acquiring the assets. That is called capital expenditure. That means if you have purchased a building, land, machineries, furnitures, plants, etc., then this is a capital expenditure, because the capital expenditure is incurred for generating the revenues over a long period of time. It helps in increasing your profit for the longer period of time. It is used for the long period of time. It is not short-term use, it is a long-term use. That's why it is called capital expenditure. So if it is a capital expenditures, from the trial balance you have to identify what are those assets. If it is a capital expenditure, then that will goes to the imposition statement. That means that is the balance sheet. So likewise, revenue expenditures, the expenditure which are used for the immediate to get the immediate benefit. For example, payment of wages, payment of rents, payment of salaries, payment of taxes, payment, that is the depreciation, provision, creating the provisions. So likewise, that is the postage, telegrams, telephone expenses. All those recurring expenses in nature are called revenue expenses. The expenses which are incurred to earn immediate benefit, that is called revenue expenses. Those expenses are current expenses like wages, salaries, etc. So those expenses will go to the income statement, that is trading profit and loss account. While you are preparing the trading profit loss account, the revenue expenses will be transferred to the income statement and capital expenditure will be transferred to the position statement because they are the assets. Revenue expenses are current expenses during that period we had done, and that will be shown in your trading profit loss account, so that to calculate the net profit or the net loss as well as the gross profit or gross loss. So that is the income statement distributed in the revenue expenditures. So I think you are clear about that. Business capital expenditure and revenue expenditure. Revenue expenditure short term in nature, capital expenditure long term in nature. Capital expenditure is purchase of assets. Revenue expenditure is the incurring current expenses, immediate expenses to get the immediate benefits. So there is the treatment is capital expenditure is shown in the asset side of the balance sheet and revenue expenditure is shown in the debit side of income statement or trading profit loss account. That is the treatment in the financial statements. While you will go for the preparing financial statement from trial balance, you have to identify what are the capital expenditure and what are the revenue expenditures. Accordingly, you have to transfer to the financial statements. So expenditure means it is a debit balance, ledger balance having debit balance. Find out whether they are the assets or expenses. If assets, transfer to the position statement, asset side. If it is expenses, transfer to the debit side of trading profit loss account. For example, purchases. Purchases is a expenses having debit balance. Transfer to the income statement, that is trading account debit side. So likewise, wages, that is transferred to income account statement, trading account debit side. But if it is a cash balance, stock, debtors, these are the assets, transferred to the balance sheet, position statement, asset side. That is the classification of business expenditures. So hope you are clear. Next is your business receipts. As you will see, there is the business expenditure is capital expenditure, revenue expenditure. The business receipts also capital receipts and revenue receipts. When capital receipts means the receipts which are occasional, not regular, recurring in nature. So that is called capital receipts, like loan, investment by outsiders. So there is the capital contributed by the owners of the business. These are the occasional. That is not regular, recurring in nature. So this type of amount are come to the business, received by the business in a large amount, but not regular, irregular, occasional. So this type of receipt is called capital receipts. But revenue receipts are the receipts which are collected or received from the sale of goods from the other sources which are in recurring nature, regular means continuous. For example, there is the sale of goods, sales. Likewise, rent received, it is a regular. The dividend received, it is a regular. Commission received, there is a regular. That is the recurring in nature. So if it is a revenue receipts, regular, recurring nature, then it is transferred to the income statement, and if it is a capital receipts, irregular, occasional, it goes to the position statements. That means the receipts always shows the credit balance. In the trial balance, you might have seen that all the credit balance are receipts. So if it is a liabilities, it is a credit balance. If it is a incomes, it is a credit balance. So if it is a liabilities, that is a capital receipts, long-term in nature. So those capital receipts goes to the liability side of the balance sheet or the position statement. But if it is a revenue receipts, regular in nature, recurring in nature, then it is goes to credit side of trading profit and loss account to prepare the financial statements to show the profit as well as to show the financial position of the business. So this is the basic fundamental idea behind classification of business expenditure and business receipts and its treatment in the from the trial balance to the financial statements. How we transport the financial statements. So there is another expenditure that is called deferred revenue, deferred expenditure. Deferred expenditure means neither capital nor revenues. It is expenditure more than 1 year but less than long term nature, less than 5 years. Like advertisement, your heavy repairs, renewals, those expenditure benefit is not for the 1 year, it may be for the 2 years, 3 years, like that. So those expenditure are also transferred to the balance sheet position statement, not to the trading profit loss account, because its amount is little bit larger than the revenue expenditure and it is not regular, it is also occasional. That's why it goes to the asset side of balance sheet under fictitious assets. So that is a deferred expenditures are there. So this type of expenditures you have to identify, classify, then it will be helps for the easy in preparing financial statements, both income statement as well as the position statement. Hope you had understood it. So in the next class we will discuss how we will prepare the financial statements. So till this you go through the books and then clear your doubts. Thank you.